You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to Watching the Financial Survival Network. I'm your host, Kerry Lutz. Got a special guest for you today. Haven't had him on the show much lately, but I think he's becoming more and more relevant. Jason Hartman. Jason, it's great to have you back. Hey, so how's it?
Kerry, it's good to be here. It's been a long time.
Well, housing is your bread and butter, single-family homes.
Right.
You have a direct stake in the damage that the Federal Reserve is doing at this particular moment. And we see different markets. Obviously, you're the one who always says there's hundreds, maybe thousands of markets in the United States. Certain markets are getting hit harder than others.
Yeah.
Is housing crash 2.0, financial crisis, mortgage collapse 2.0 on the way, or are we just trying to fit current circumstances into historical precedent?
Kerry, that is the trillion-dollar question, no question about it. And lots of people with lots of opinions over the past several years. What does that say on your mug?
You read that?
No, can't see it. Liberal teas?
Tears.
Oh, tears.
Very sweet.
Yeah. So that is the trillion-dollar question about housing. And let's talk about a few things. So number one, you alluded to all the different types of markets. And you're certainly right. There are about 400 metropolitan areas in the U.S. There are over 3,100 counties. There are over 9,000 cities. There are countless neighborhoods beyond that. All real estate is local. As we've talked about over the years, and we've known each other a long time now, Kerry, three major types of markets: linear markets, cyclical markets, and hybrid markets. The cyclical markets, the ones that their chart of appreciation and depreciation over time would look like a roller coaster, big ups and downs, those are getting hit really hard. They went up way too far. They're coming down fast. The linear markets, slow and steady wins the race. It's like the tortoise and the hare. Those are doing pretty well. But the next thing we've got to ask ourselves is to segment not just by geography, but also by price, because the pricing of these different markets is very, very important to look at. For example, for the last 14, 15 years coming out of the Great Recession, builders have really just not built entry-level homes in any appreciable way. I mean, it used to be that like an entry-level new home was $150,000, $170,000. Okay, now an entry-level new home is $350,000 or even more. Okay, so we're really kind of divided into two types of markets also. There's a lot of ways to segment things: resale market and new home market. And what I want to say there, and I'm going to show you a chart that is one of the things, Kerry, I call one of the most important charts in real estate. And here it is. You ready to have your mind blown? This is big. Okay. This is big. Here it is. Okay, everybody, pay attention. Look at this. And if you're listening on audio only, I'll tell you what this says. It basically shows us that of all the mortgaged homes in the United States, about 25% of them have a mortgage rate of 3% or lower. And Kerry, just think of it. Those people have 28 to 29 years left on that mortgage. 65% of all the homes with mortgages in the U.S. have a mortgage rate of 4% or lower. Now, if you want to have a real estate crash, there is one ingredient that is absolutely necessary, and it is a distressed seller en masse. During the Great Recession, we had millions and millions, even tens of millions, really, of distressed homeowners that were underwater, They could not afford their mortgage. Now we have a very different situation where we have lots of people that find their homes to be very affordable if they bought them during the lowest interest rates in 5,000 years. And you and I have are both familiar with that great book by David Graeber, the late David Graeber, called Debt, the First 5,000 Years. So these mortgage rates are keeping properties off the market, and inventory is actually historically low, even though demand has just kind of evaporated due to these high interest rates. So it's a really weird time we're in. That's the resale market. But the new home market is very different from the resale market because a lot of developers ramped up production during COVID because there was so much more demand. And a lot of their new homes have been coming online just recently and will continue to come online. So new home builders are cutting prices and making deals. The problem is they're building more expensive homes. They're not building cheap homes because they can't afford to build cheap homes because there's no margin in them. So it's a really, really weird time.
Yeah, well, I think there's another reason we're never going to see a mass foreclosure scenario again. I don't think the politicians have an appetite for it.
Yeah, good point.
And they took too much flack last time. Banks get bailed out, Main Street gets screwed. And also, I think that there's this thing where stigmatism that used to be for foreclosure or bankruptcy isn't there anymore. But we got this dissolving of societal norms. It's legal to shoplift in major market areas, major cities like New York, like LA, like San Francisco.
Oh, San Francisco's the poster child, yeah.
So what we've got is that most mortgages are government-backed anyway.
Yep.
And the banks are willing to take the profit, and then the government's willing to take the loss, the concept of the accommodating loser.
Yeah.
So the government will just let it go. We're not going to see mass foreclosure scenario other than for taxes, for governmental fees. That's the only way there will be a foreclosure. There will be no more private foreclosure market anymore. And we saw the analog for that, I think, during the pandemic when we had a foreclosure moratorium. We've had them before in the past during the Great Depression and at other times, farm moratoriums. We've had it at other times. But I think push comes to shove, you will see that they just won't do it. They'll hand the paper over to the government and say, let you guys deal with it, right?
Yeah, no, I agree with you. And, you taught me something years ago. I thought it was a great saying. You told me that in any transaction, the government is always the willing loser. And you're right, and so the government, i.e. the taxpayers or the consumers who are hurt by inflation, that's just the inflation tax as opposed to the income tax, still a tax nonetheless, will take the brunt of it. That is the government. It's us, right? And so, it's a really interesting situation. In any time, boom or bust time, recession, boom market, whatever, about 1% of all mortgages in any given time, on average, are usually in some stage of default. Now, that could mean they're 30 days late, 60 days late, 90 days late, or they've had a notice of default filed where they're actually in the foreclosure process, or they're right at the end of the foreclosure process where the house is being sold on the courthouse steps. Some stage of default along that spectrum. At any given time, on average, about 1% of all mortgages are in default, in some stage of default. Right now, we only have about 0.5% in default. So the default rate is down by 50%. It's likely to go up a bit, but again, we are far from a distressed market. And let me show you this chart. I think you'll find this really interesting, Kerry. This is inventory, and this shows you the number of listed properties in the United States. And as you can see, back in about 2015, we were in a somewhat normal market where we had about 1.2 million homes for sale at any given time, right? And right now, we have just over 400,000 homes for sale. Now, That's not the lowest it's been when the housing market was just savage and you couldn't buy a house to save your life. Some houses had literally 80 offers on them in a matter of days. We saw the videos, we saw the craziness. Then, we got down to where we only had like 248,000 homes for sale. Okay. But now we only have about 412,000. And I find it really valuable if people look at the market like this. Liken it to a sink. I think this is a good metaphor, a sink, right? You have the faucet of the sink, and that represents the new inventory coming on the market. Right now, that's just a trickle. It's a little more, if you look at hot and cold water, maybe, what's coming out of the faucet. It's a little bit more on the new home side, but on the resale side, there's hardly anything coming on the market. So the water's trickling out. In the sink, if you considered a full sink being a normal market, right, the sink is only about 1/3 full right now. That's the existing inventory of homes on the market, only about 1/3 full. And then you look at the drain. The drain represents the buyers that are absorbing the inventory. Now, the drain is plugged up, okay, because sales volume is down anywhere between 20 and about 35%, depending on the market. So demand has been reduced thanks to the Fed raising interest rates like crazy. So we've got this situation where inventory is trickling out. There's only about 1/3 of the water in the sink, the inventory, and then the inventory is being absorbed at about 2/3 of the normal rate, maybe, a little less than that on average. So it's a strange time. This really hasn't happened this way before. Usually what we'd see with this massive spike in interest rates is normally we would see that sink filling up and overflowing, but we're just not seeing it because these people have these super cheap mortgages. And by the way, I didn't mention this earlier, but about 40% of the country has no mortgage at all, zero mortgage. So it's very hard to get into distress when you have 25% of the country with interest rates below 3% for the next 28 years. You have 65% of the country with interest rates below 4% for the next 28 years. And you have 40% of the country with no mortgage at all. So where's the distressed homeowner going to come from? It's very unlikely that we'll see that.
It just reminds me when my father built our house in 1963, he had a, $35,000, $50,000 mortgage on it. I think his monthly mortgage payment was like $350. It was like a 2 or 3% mortgage.
Yeah.
Plus, I think he got VA and all that.
Right.
So he was paying $300-400. Now that home is worth probably close to $2 million.
Wow.
And it probably has a 3% mortgage on it now.
Yeah.
And but when you think about the relative payments, taxes granted have gone up. They were probably $2,000 back then. They're probably $25,000 now. You think about it, inflation. When my mother finally sold the house in 1984, there was about $5,000 left on the mortgage, and but her payment was like $350 a month, and the house, even at that point, was worth $400,000. So your inflation-induced destruction,
yeah,
alive and well in the United States, and promising to get even better.
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah, no, that there's no question about that. Inflation-induced debt destruction is a phenomenal strategy, and it is the way you borrow money at today's dollars, and as it devalues over time, most people get hurt by inflation because they're in the wrong assets. Mortgages, cheap long-term fixed-rate mortgages are an asset, literally, because you pay them back in cheaper dollars. So it is definitely a beautiful, beautiful thing. It's a mouthful to say inflation-induced debt destruction, but it's a great strategy.
Yeah. Well, unless we have deflation, the strategy has to work.
All right.
Because even when there's no inflationary crisis like we have now, there's still a 2-3% a year, and you just have to use the rule of 72 to figure out that. Even at 5% inflation, that means that basically in 14 years, I guess it is.
Mm-hmm. Yeah, that's about right. Because if it were 6%, it would double in 12 years.
Right.
Yep.
So it'll be less than half.
Yep.
And so all you got to do is hold on. Now, during the mortgage crisis, an interesting little cottage industry popped up. I don't know if you followed it or not, but people couldn't get buyers for their homes, and they couldn't afford them. So what they would do is they put the home into a trust, and then assign they're the trustee in the trust, and a buyer would come along, give them cash, whatever, 10, 20,000, and they would make them the trustee of the trust.
Yeah.
And it was because you have a due on sale clause, and you can't assume mortgages other than certain VA mortgages and stuff.
Right. Yep.
Can't do it. So people were selling these homes through a trust, and it was a little shady for sure.
Yep.
But technically, if the bank doesn't know, nobody's hurt, right?
Yeah, they do. They've been, for a long time, people have been doing what's called subject to mortgages or wraparound mortgages.
Yeah.
Or AITDs, which stand for all-inclusive deed of trust deed. There are ways around it, but in essence, if the lender finds out, it could be problematic.
And it's on your credit.
Yeah.
But if there's no other way to sell it, people can't afford the house.
Right. Well, it's interesting that you mentioned the due on sale clause, because the due on sale clause was upheld by the Supreme Court, I think in around 1978 or something like that. I'm sure I'm wrong about that, but it's somewhere around there. And what that basically did is it allowed mortgage holders, who made the loan, the banks, right, the lenders, to say that when you transfer the title to this property, you have to pay off the loan. You can't let the buyer take over the loan. And what's interesting about this is I say we are going to have an inventory shortage for the next 28 years, unless suddenly there's a whole bunch of new supply built, because all of these people have these super cheap mortgages they're never going to want to let go of. Now, two ways that could change. Number one way is we could have those super low interest rates again, right? If we saw rates go down to 2.75 or 3%, then that changes everything, right? Then, the rate of all the existing homeowners' mortgages are equal to the market rate, and they'll move and inventory will change hands. But that's very unlikely that we're going to see rates that low again. So, because those were artificial, obviously. So the other thing they could do is they could repeal the due on sale clause. And that would cause inventory to change hands, because guess what would happen? Take, for example, your house, Kerry. I think you've got one of these super cheap mortgages on your place. You've got a great house, and you moved at just the right time. I mean, you timed it perfectly. And if you could sell that house and let the buyer assume that low rate mortgage, that would make your house more valuable than other houses that didn't have a cheap mortgage like that. Okay, so it's really interesting. We're in this weird situation where, since there is a due on sale clause and it's in force, that you can own something and it's more valuable to you as the owner than it is to the marketplace. because yours is packaged with a cheap mortgage, but the new buyer's version of your property is not packaged with a cheap mortgage. So it's more valuable to you than it is to somebody else, right? It's like vastly more valuable. So it's a really interesting time for sure.
Yeah. Well, the trust is an effort to like do an end run around on sale, and it would be debatable if it would hold up or not.
Yeah,
because it's the John and Jane Doe Trust, and they own the house because you transfer it, and every state allows you to transfer your home to a trust without triggering the due on sale, and then you simply substitute trustees, and nobody's any the wiser because it's the John and Jane Doe Trust, and they're on the deed.
Yeah.
So maybe you're going to see a return to this. I always thought it was questionable, but it was used extensively during the financial crisis. Thousands and thousands of homes. I didn't see any cases where the banks went after it, but could well be the case.
Yep.
So what about the return of owner financing, Jason?
We shall see. Again, 40% of the properties in the United States are free and clear, so the owners could finance them. By the way, back to our prior conversation, even if the due on sale clause, even if you can get around it with one of the ways we talked about, like the trust or the other methods, or if it were repealed and say, hey, there's no more due on sale clause, lenders, tough luck, still the problem would be the existing amount of equity in that house would have to be somehow financed, right? So the seller could carry a second loan, a second mortgage for the balance, and maybe have the buyer put some money down. But I don't know. I think most sellers would be wise enough to know that if they're lending money in an inflationary environment like this, they're getting killed, with those loans, right? It's okay if they're shorter term loans, but if they're longer term, it's very risky because inflation is just eating into your returns. In fact, everybody's complaining about interest rates being so high now. So say, for example, you get a mortgage and it's 6.5%, right? Just as an example. Well, the inflation rate officially, is one number, right? But the unofficial inflation rate is the real number, not the consumer price index, but the number we all know. And Kerry, I haven't talked with you about this lately, but I know you don't believe in the CP lie. That's what I call it, the CPI.
Yeah, big lie, all right.
Yeah, it sure is a big lie. So I would say the real inflation rate is somewhere around 15%. So if you borrow at 6.5% and the real inflation rate is 15%, you're still getting paid 8.5% to borrow the money. And that assumes you don't have someone in your property, if it's an income property, paying the mortgage for you and then paying you a little bit of positive cash flow every month to benefit if it's a rental. But even if it's your own home, you're getting paid to borrow the money because we still have negative interest rates in real terms.
Right. Anytime there's negative interest rates and your loan is less than the real rate of inflation, then the differential there is effectively a profit to you. And it's basically causing in addition, the value of assets go up in inflationary times, which is why the rich get richer and the poor stay poor. Hey, so what does this all mean to your business? I mean, we've been talking a lot of theory here, Jason, but people are still buying investment homes here in the droves, or
great question.
We're financed.
Yeah. So we help people buy properties in several parts of the country. Our busiest markets are Florida and Alabama, but also Tennessee is quite busy, Indiana, some other markets as well. And we vet the best markets for people to buy in. And last year, when we saw the biggest spike in the interest rates, for about 2 to 3 months, things were pretty slow for us because buyers were just kind of like, I don't know what to do. Everybody was freaking out. But then we saw that about half of our clients were still buying, even if they considered that they were just dollar cost averaging into the market. They were just buying properties because the question is, compared to what? Like, even if the real estate deals aren't as good as they used to be, and they're certainly not, okay, neither is anything else. What else are you going to do, right? What is the alternative? And we all know about that acronym TINA. There is no alternative, right?
Alternative.
Yeah. And so what else are you going to do? I mean, you should have some gold and precious metals for insurance. You have some real estate, which is hopefully your real growth portfolio, income property. And, maybe you dabble around with crypto. I don't know. That's pretty speculative stuff for sure. But, what else are you going to do?
Kleptocurrencies.
Kleptocurrency. I like that.
Ample examples. We have, all of that. Well,
yeah. But to answer your question just quickly, so after about that 2 or 3 month slow period, business started really rushing back, and it's been pretty good. I mean, it's been actually surprisingly good. People are buying properties for sure.
Even if you're breaking even on the property, all right, meaning cash flow, neither cash flow negative nor positive. Even if you're breaking even on it, you're playing the inflation arbitrage. Remember that old saying from Will Rogers, invest in inflation? It's the only thing going up.
Yeah, that's
right.
Will Rogers also said, buy land. They're not making any more of it.
Not making any more of it, especially waterfront property. But there might be a lot less if there's a few bad storms in Florida. That's for sure.
Yeah, well, that's we don't do any waterfront properties, so that's a whole different ball game. Well, those don't work for rental.
Predictions about California that eventually Nebraska will be waterfront property.
Yeah,
I don't know. From that hasn't happened yet. But the old thing, this is how you make money in inflation.
Yeah.
All right. In inflationary times, buying assets that cash flow, that you can get other people to pay the debt on. And even if there isn't a substantial profit, there could be tax benefits to it. For sure. There is what would you call forced to pay down of your debt.
Yep.
And
your tenant is paying your loan off for you.
Right. Yeah, when you get other people who can pay off your debt for you, it's a good deal.
Yeah, it definitely is. There's no question about it. That's why income property is the most historically proven asset class in the entire world. And it's the most tax-favored asset class in the United States.
And we talk about this, and, it wasn't coincidence that I purchased my home when I did. I knew it was coming.
Yeah.
There was never a question in my mind. I knew real estate prices because you're printing money. All right.
Oh, yeah. Your timing was phenomenal. I mean, you did great.
Partly lucky because you know how many houses I'd looked at before I bought this one? Now, I was picky, I will say, but push comes to shove, I would have just bought any house. All right. I would have just bought one, but I wanted security. I wanted, space, location, all that. And I was lucky. But in the end, I would have taken a lesser house or more of a house. I could have paid more. I was trying to live beneath my means for once in my life, and it worked. And, but I'm not a genius. Anybody who looked at things could have seen exactly what you and I saw, Jason.
Yeah.
Exactly. So, but it still applies. Not as good a deal as it was because the rates are 6-7%, but still a good deal because you're getting the inflation subsidy. You're playing the inflation arbitrage. That's why you need to go over to jasonhartman.com. Any other sites we should think about here, Jason?
I've been paying a lot more attention to YouTube in the past couple of years. So check me out on YouTube. Just type Jason Hartman. And then, of course, my podcast, whatever platform you're listening to, Spotify, whatever, just type Jason Hartman, iTunes, Spotify, whatever, and you'll find me. And, it's always great talking to you and your audience. Say happy investing to everybody.
All right. Thanks, Jason. Hey, if you've got a question for Jason, shoot me an email, kl@kerrylutz.com, and go over to financialsurvivalnetwork.com. The link to Jason's site will be there, and you just click through and sign up for your free newsletter. Jason, always a pleasure, and we'll talk to you again soon. I have a feeling things are going to get crazy.
Sounds good. Happy investing.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.